Picture a room with 100 seats. It could be a school hall, a movie theater, a work event, any place where a lot of normal people sit and talk. Now think about money in that room. Most people in those seats look fine. They smile, they joke, they post pictures, they buy things, they act calm. But behind the scenes, a lot of them are one surprise bill away from stress. A lot of them are using debt to hold their life together. A lot of them are making money choices based on fear or FOMO or the need to look successful. And then there is usually one person who is different. Not louder, not flashier, not the one with the newest car, just calmer. That person is hard to shake, hard to scare, hard to trap. When markets drop, they do not fall apart. When the internet screams, they do not rush. When prices look crazy, they do not chase. That person is not lucky. They are built for the long game. This video is about how to know if you are that person. Not by your income, not by your job title, not by your followers, not by a big win last week, by your signs, your habits, your mindset. Because in long-term investing, the biggest edge is not a secret. It is not speed. It is not a hot tip. It is temperament. It is patience. It is having enough safety in your life that you do not get forced into bad moves. Fast money culture hates this message. Fast money culture needs you to feel behind. It needs you to feel late. It needs you to feel like you must act today, because when you feel that way, you click, you trade, you chase, you overpay, you panic sell, you start over, again and again. Slow wealth is the opposite. Slow wealth is built with boring steps done for a long time. Slow wealth is built when you can sit still while other people lose control. So here are 10 money signs you are ahead of 99% of people. These are not feel-good signs. These are real signs. Some will challenge you. Some will hit your ego. That is fine. Keep score as we go. Be honest. This is for you, not for comments. If you hit 7 or more, you are not average. You are rare. Now let's start with the first sign. It is the one that makes all the other signs possible. Sign 1. You are hard to force. Most people do not lose money because they are dumb. They lose money because they get trapped. They get trapped by bills, by debt, by high fixed payments, by a lifestyle that needs perfect income every month. Then something small happens. Hours get cut. A client leaves. A car breaks. A medical cost shows up. A rent jump hits. A rate changes. A market drops. And suddenly the person is not choosing anymore. They are reacting. They sell what they should hold. They borrow at bad rates. They cash out long-term plans to fix short-term pain. They take the first deal, not the best deal. So the first sign you are ahead is simple. You have breathing room, not because you are rich, but because you built space. You might have an emergency fund. You might have low monthly costs. You might have a small buffer in cash. You might have a plan that can bend. Here is a clean test. If your income dropped tomorrow, how many months could you keep your basic life steady without panic? Not survive, not eat noodles. I mean steady, pay the main bills, buy food, get gas, handle medicine, fix a small car problem. If you know your number and you are building that number, you are ahead, because your number is not just math, it is peace. It is time. It is the power to wait. And in investing, the power to wait is not small. It is everything. Waiting is what keeps you from selling at the worst time. Waiting is what lets compounding do its job. Compounding is not just money growing. Compounding is also mistakes not happening. If you can avoid one panic sell in your life, you can save years of lost progress. So if you have space, even a small amount, you are already ahead of the crowd that lives tight. Sign 2. You track reality, not vibes. A lot of people feel their finances. They feel broke, even when they are fine. They feel safe, even when they are not. They feel behind because they see someone online flexing. Feelings are not facts. Being ahead means you know your facts. You know your core numbers, not every number, not a huge spreadsheet, just the few that matter. You know what comes in each month. You know what must go out each month. You know your high-interest debt, if you have any, and you know the rate. You know your cash buffer in months, not just dollars. You know your net worth trend over time, even if it is small. This matters because you cannot fix what you refuse to measure, and the market will test you. If you only use feelings, the market will control you. Green days will make you greedy. Red days will make you scared. News will make you rush. But if you use simple tracking, you can talk to yourself in a calm way. You can say, my base is fine. My bills are covered. My buffer is there. I do not need to react. Or you can say, my base is weak in one spot. I will fix it step by step. That is power. That is how adults handle money. Here is a simple inner question that shows you are ahead. When you feel stress about money, do you check your facts or do you scroll for comfort? Most people scroll. People who are ahead check facts. Then they act once, not 10 times. If you are doing that, you are already in a small group. Sign 3. You think like an owner, not a trader. This is where long-term value thinking starts. Most people look at a stock like a lottery ticket. They ask, will it go up soon? Owners ask different questions. Owners ask, what is this business? Owners ask, how does it make money? Owners ask, why do customers keep coming back? Owners ask, what could break it? When you think like an owner, you stop chasing price. You start judging quality, and quality is what survives storms. Here is the sign. If you own something, you can explain it in one clear sentence. Not a long speech, not fancy words. One sentence. Something like, this business sells a product people use often, and it earns steady cash doing it. Or, this company helps other companies do a hard job faster, and it has long contracts. If you can't explain it simply, you might not understand it. And if you don't understand it, you won't hold it when it gets scary. Because fear always attacks what you do not understand. Fear says, you never knew what this was anyway. Get out. So being ahead means you invest inside your understanding. You do not need to know everything. You need to know what you own and why you own it. This is also how you avoid hype. Hype is loud. Hype is fast. Hype loves big stories. Owner thinking is quiet. Owner thinking is slow. Owner thinking loves real numbers and simple logic. A clean rule that shows owner thinking is this. If you would not feel good buying the whole business and holding it for years, you should be careful about buying even a tiny piece. That rule alone puts you ahead of most people. Sign 4. You have rules for your emotions. This is the sign that separates smart from successful, because smart people panic too. Smart people chase too. Smart people still get dragged by the crowd when stress hits. Being ahead means you do not trust your feelings with big money choices. You respect your feelings, but you do not let them drive. You have rules. Rules are simple sentences you follow when your brain is hot. Because when your brain is hot, it lies. Fear lies. It says this pain will never end. Greed lies. It says this time is different. You can't miss it. FOMO lies. It says everyone else is winning. You are falling behind. So your rules need to be ready before the moment comes. Here are examples of rules, not advice, just examples of how calm investors protect themselves. One rule is the 24-hour rule. I will not make a major change when I feel fear or excitement. I wait one day. Another rule is the headline rule. I will not act because of a headline. I will only act after I check the business and my plan. Another rule is the screen rule. I will not check prices all day. I check at a set time and then I live my life. Another rule is the position size rule. I will not hold more of something than I can hold calmly. That last one is important. If your position is so big that you cannot sleep, it is too big. It does not matter how great the story is. Sleep is part of risk control, and risk control is part of compounding, because the goal is not to be brave. The goal is to stay in the game. If you have any real rules like this, written or clear in your head, you are ahead. Most people have goals. They do not have rules. Goals are what you want. Rules are how you behave when you are stressed. Rules are what keep you from ruining your own plan. Now here is where this gets even more important. There is a big difference between being calm and being careless. Calm investors still think hard. They still respect risk. They still want a margin of safety. And that brings us to the next sign, which most people skip when they get excited. But we will save that for the next section, because it changes how you pick what to own, how you avoid overpaying, and how you spot a strong business before the crowd does. So far, ask yourself, do you have breathing room? Do you track your reality? Do you think like an owner? Do you have rules for fear and greed? If you have these, you are not just doing okay, You are building the base that makes long-term wealth possible. In the next part, we will go deeper into the investing signs. How you use a margin of safety without trying to predict the market. How you spot a moat in plain words. How do you tell the difference between a great business and a great price? And how patient people quietly win while hype chasers keep starting over. When you're ready, tell me to continue, and I'll write the second section. In the first part, we covered the base signs. Space, tracking, owner thinking, emotional rules. If you have those, you are already building something most people never build. Now we move into the investing signs. These are the ones that protect you when the market gets loud. These are the ones that keep you from paying too much, chasing hype, or quitting at the worst moment. This is where people who know investing and people who do investing split apart. Because knowing facts is easy, staying rational is hard. Sign 5. You understand the difference between a great business and a great price. Most people hear great company and their brain stops thinking. They assume great company equals great investment. That is not true. A great business can be a terrible deal if the price is too high. And a boring business can be a great deal if the price is low and the business is steady. Price matters, not because you are trying to time the market. Because price decides your margin of safety. Here is the simplest way to think about it. Value is what you get. Price is what you pay. Most people stare at price all day. Up, down, red, green. They treat it like a scoreboard of truth. But price is not truth. Price is a mood. Value is closer to truth. Value is based on what the business can earn over time. Being ahead means you can hold two thoughts at once. This is a strong business, and it can still be too expensive. If you can think that way, you avoid one of the biggest traps in investing, overpaying. Overpaying does not feel risky in the moment. It feels smart. It feels safe. It feels like you bought quality, but overpaying is a hidden risk. It is like buying a great house at a crazy price. The house is still great, but you can still regret the price. A simple rule that shows you are ahead is this. If you need a perfect future to justify the price is probably too high. Perfect future means everything must go right, growth must stay high, costs must stay low, competition must stay weak, the economy must stay friendly. That is not a plan. That is a wish. So what do calm, long-term investors do instead? They look for room. They want a gap between what they think something is worth and what it costs today. That gap is margin of safety. Margin of safety is not a magic number. It is a mindset. It says, I want space for being wrong, because you will be wrong sometimes. Everyone is. The goal is not to avoid mistakes. The goal is to make mistakes small and wins large over time. Here is a quick margin of safety check you can use in plain language. Ask these 3 questions. First, if the next few years are just okay, not amazing, does this still make sense? Second, if the market drops and fear rises, will I still feel good owning this business? Third, am I buying because I understand the value or because I fear missing out? That last question is huge. FOMO makes people pay any price. Then they call it long-term. But long-term is not a label you slap on a bad price. Long-term is a process. If you respect price, you are ahead. Because most people only respect price after they get hurt. Sign 6. You can spot a real moat without using fancy words. People love the word moat. They say it like it is a spell. But a moat is simple. A moat is the reason customers stay, even when a competitor shows up. It is the reason profits do not disappear the moment others copy the idea. Being ahead means you do not fall for new and exciting without asking, what stops others from taking this? Here is the hard truth. Most businesses are not protected. Most businesses are a good idea that will get copied. And when ideas get copied, prices drop, profits shrink, and the business becomes a fight. A real moat reduces the fight. It does not remove competition. It just gives the business an edge that lasts. Here is a moat checklist you can understand in minutes. Ask these questions. Do customers love the brand so much they do not even look around? Do customers have a real cost to switching, like time, training, or risk? Does the business get stronger as more people use it, like a network? Does it have a cost advantage, like scale, supply, or a better process? Does it have a rare asset, like trusted data, a special license, or a strong distribution system? You do not need all of these. but you need at least one strong reason why the business can defend its profits. Now here is another way to test a moat. It is a simple mental game. Imagine a smart competitor with a lot of money appears tomorrow. They want to steal customers. What do? Can they do it fast? If they can copy the product in 6 months and steal customers with discounts, that is not a moat. That is a temporary lead. If stealing customers is hard, slow, and expensive, that is closer to a moat. And being ahead also means you understand this. A moat is not forever. Moats can shrink. New tech can change habits. A bad manager can damage trust. A company can get lazy. So you do not just ask, does it have a moat? You also ask, is the moat getting stronger or weaker? A simple way to see that is to look at behavior. Are customers staying? Are margins steady? Does the business keep earning strong returns without needing huge debt? Is it still the first choice, or is it living on old fame? If you naturally think in these questions, you are ahead, because most people do not study business. They study price charts. They think the market is a game of guessing. Owner-minded people know the market is a place where businesses get priced. Sign 7. You respect the balance sheet, even when the story is exciting. This sign is not popular. It is not flashy, but it saves people in recessions and bear markets. A weak balance sheet is like a boat with holes. On a sunny day, it still floats. In a storm, the holes matter. Many investors ignore debt when times are good. They say debt is fine. Everyone uses debt. Sometimes debt is normal. Sometimes it is smart. But too much debt removes options. And recessions punish businesses with no options. Being ahead means you notice the weight before the storm. You do not need to be an accountant. You just need to ask simple questions. Does the business have plenty of cash? Does it have manageable debt? Can it pay its bills even if sales drop? Does it need to refinance often just to survive? Does it have room to breathe? This matters because a business with strong finances can play offense when others are weak. It can keep investing. It can keep marketing. It can buy competitors. It can survive long enough for the cycle to turn. A weak business does the opposite. It cuts the wrong things. It sells good assets cheap. It dilutes owners. It makes desperate choices. So here is a clean decision rule that shows you are ahead. Never let a good story trick you into ignoring a fragile structure. Stories are easy. Structure is real, and structure is what keeps compounding alive. Now let's connect this to your own life too. Many people want to invest for the long term, but their personal balance sheet is weak. High interest debt, high monthly payments, no buffer. That creates forced selling. So being ahead often means you are fixing both balance sheets at once. The business balance sheet and your own. Because if your own life is fragile, you will not act like an owner in a downturn. You will act like someone who needs cash now. And that is where long-term plans go to die. Here is a quick personal structure check. Do you have any high-interest debt that eats your future each month? Do you have fixed payments that make you stressed? Do you have a buffer that buys you time? If you are reducing fragility step by step, you are ahead because you are building a life that can hold a long-term plan. Sign 8. You have a plan for red markets before they happen. This is one of the rarest signs. Most people make their plan during the panic. They wait until prices drop. Then they ask, what should I do? That is too late. Not because you need perfect timing, but because you need calm thinking. And calm thinking is hardest when your screen is red and everyone is yelling. Being ahead means you plan in quiet times. You decide what you will do when fear shows up. You do not guess the bottom. You do not try to be a hero. You just follow a process. Here is a simple framework for a red market plan. It has 3 parts. First, your hold rule. This means you define what would truly make you stop owning something, not the price fell. Real reasons. Like the business is losing its moat. The debt became dangerous. Management changed and started hurting owners. The core story broke. If you do not define this, your brain will invent reasons in the moment to match your fear. Second, your checklist rule. When prices drop, you do not scroll for comfort. You run a checklist. Here is a simple checklist you can use. What changed in the business, not the stock? Are customers still there? Is the balance sheet still strong? Is the business still earning real cash? Is this fear about the whole market, or is this company truly weaker? You are not trying to predict headlines. You are trying to check reality. Third, your action speed rule. Most people move too fast in stress. They sell everything in one day, or they buy everything in one day. Both are often emotional. So calm investors slow down on purpose. They make one small move, then reassess. They keep their mind clear. They avoid the feeling of "I must do it all right now," because that feeling is usually not logic. It is panic wearing a mask. If you already think like this, you are ahead. You are building a process that works in real markets, not just in good markets. Now, there is one more layer here. A plan is not just about what you do. It is also about what you do not do. Being ahead means you know what to ignore. You ignore the loudest voices. You ignore end-of-the-world posts. You ignore people who brag when things go up and vanish when things go down. You ignore the urge to check your account 10 times a day, because constant checking does not make you safer. It makes you reactive. And reactive people do not compound well. So a strong red market plan often includes an attention rule, like, when markets are wild, I check less or I only read my long-term notes, not the daily news or I talk to one calm person, not 10 loud people. If you have even a basic plan like this, you are ahead of most people who let the market set their mood. So pause and score yourself again. Do you respect price and margin of safety? Do you look for moats, not just excitement? Do you respect balance sheets, not just stories? Do you have a plan for red markets before they happen? If you have these, you are not just investing, you are building an owner system. And now we are down to the last 2 signs. These are the signs that decide who stays consistent for 10 years and who quits after 2. One is about your attention. The other is about patience and compounding. Most people think those sound soft. They are not soft. They are the difference between a calm investor and an emotional one. Tell me to continue, and I will write the final section with signs 9 and 10, plus a simple self-score and a strong ending that ties everything together. Now we reach the last 2 signs. These are not about being smart. They are about staying steady for years, because the biggest reason people fail is not that they pick the worst investments. It is that they quit too soon, or they change plans every time the market makes them feel something. So here are the final 2 signs you are ahead of 99% of people. Sign 9. You protect your attention like it is money. Most people think investing is about money, but investing is also about focus. Because what you focus on becomes what you fear, and what you fear controls what you do. Right now, the world is built to steal your attention. Apps want you to scroll, news wants you to worry, social media wants you to react. Day trading culture wants you to feel like you must act today. And meme stock hype wants you to feel like everyone is getting rich, except you. That is not an accident. Fear and greed keep people glued to screens. Screens create clicks, clicks create profits, but those profits are not for you. So being ahead means you do something most people will not do. You set rules for your attention. You build an information diet, not because you are weak, because you are realistic. You know you cannot think clearly if you fill your mind with noise all day. Here is the hard truth. More information does not always make you better. Sometimes it makes you worse. Because too many opinions create doubt. Too many alerts create stress. Too many headlines create the feeling that you must do something. And do something is not a strategy. It is a feeling. So how do calm investors protect their attention? They use simple limits. Here are a few strong rules you can use as examples. One rule is the news delay rule. I do not react to breaking news. I wait until I can think. Breaking news is almost never complete. It is loud before it is true. Another rule is the price check rule. I do not check prices all day. I check on a set schedule. If you check prices 20 times a day, you train your brain to feel 20 emotions a day. That makes you reactive. Reactive people do not compound well. Another rule is the source limit rule. I only follow a few calm sources. I ignore the rest. Most people follow 50 voices and end up with 0 clarity. It is better to have fewer inputs and stronger thinking. Another rule is the hot topic rule. If something is trending everywhere, I slow down, not speed up. When everyone is excited, prices can get silly. When everyone is scared, prices can get silly too. Crowds create extremes. Your job is to stay normal when others are extreme. Now let's make this very practical. Here is a simple framework called the information budget. Think of your attention like a wallet. Every day, you get a limited amount of focus. If you spend it on noise, you have nothing left for real thinking. So pick a budget. For example, you might choose 10 minutes a day to check markets, 10 minutes a day to read business news, one deeper session per week to review what you own or follow. That is enough for most long-term investors, because long-term investing is not a sport where you need second-by-second updates. It is more like owning a farm. You check the soil, you check the weather, you make smart choices, then you let time work. Now here is a simple question that shows if you are ahead. When you feel market fear, do you increase your screen time or reduce it? Most people increase it. They watch more videos, they read more posts, they refresh more charts. They do it to feel safe, but it makes them less safe because it makes them emotional. People who are ahead do the opposite. They reduce inputs. They go back to their plan. They check their checklist. They calm their mind. They protect their attention. If you do that, you are ahead, because attention control is emotional control, and emotional control is risk control. Sign 10. You let compounding work by staying consistent and not resetting your progress. This is the final sign, and it is the most important. It is also the most boring, and that is why it is rare. Most people love the idea of compounding, but most people do not live in a way that allows compounding, because compounding needs time, and compounding needs you to stop touching the stove. It needs you to avoid big mistakes that erase years of progress. A lot of people do the start-stop cycle. They invest when things feel good. They stop when things feel bad. They chase what just went up. They sell what just went down. They switch strategies every year. They bounce between fear and greed. That is not compounding. That is restarting. Being ahead means you are building a system you can follow for a long time, even when it is boring, even when it is slow, even when no one claps for you. Here is what this looks like in real life. It looks like making small, steady moves. It looks like adding to savings. It looks like investing with a calm plan. It looks like being okay with years that are not exciting. It looks like not needing to win this month to feel smart, because you understand something the crowd forgets. The market does not pay you for activity. The market often pays you for patience. Now, patience does not mean doing nothing forever. It means doing the right things at the right speed. It means acting with a clear mind. It means staying away from moves that can destroy you. So here is a simple compounding protection checklist. These are behaviors that protect your long-term results. First, you avoid big debt that can force you to sell. Second, you avoid overpaying for hype. Third, you avoid holding things you do not understand. Fourth, you avoid position sizes that break your sleep. Fifth, you avoid panic decisions made in a hot emotional state. These are not fancy, but they keep you in the game. And staying in the game is where compounding happens. Now here is a piece most people miss. Compounding is not just numbers. Compounding is identity. If you see yourself as a calm owner, your actions start to match that. You stop needing the market to prove you right every week. You stop needing constant excitement. You stop caring about what strangers are buying. You start caring about your process. You start caring about business quality. You start caring about price and margin of safety. And over time, that identity compounds too, because each calm decision makes the next calm decision easier. Now listen to this inner dialogue. This is what it sounds like when someone is ahead. I do not need to catch every winner. I only need a few good decisions repeated for years. I do not need to predict the next headline. I need to predict the next headline. I need to avoid dumb mistakes when headlines get loud. I am not here to impress anyone. I am here to build a strong future. If you talk to yourself this way, you are ahead, because the market is not just a test of your knowledge. It is a test of your temperament, and temperament is the hidden skill. Now let's add everything up. Here are the 10 signs again, fast and clear. You are hard to force. You have breathing room. You track reality with a few key numbers. You think like an owner, not a trader. You have rules for fear and greed. You know great business does not always mean great price. You can spot a moat in plain words. You respect balance sheets and avoid fragile stories. You have a plan for red markets before they happen. You protect your attention and avoid noise. You stay consistent and let compounding work. Now score yourself. Be honest, not to judge yourself, to see your next step. If you hit 0 to 3, you are not bad. You are just early. Your goal is simple. Build the base. Get breathing room. Track your numbers. Write 2 rules for fear and greed. If you hit 4 to 6, you are in a strong middle. You have some real habits. Now you tighten the owner skills. Price discipline. Margin of safety thinking. A simple moat checklist. A red market plan. If you hit 7 to 10, you are ahead of the crowd in the way that matters, not because you are perfect, but because your system is built for long time. You are less likely to get forced, less likely to panic, less likely to chase, more likely to stay calm and act with reason. Now here is the most important part. This is not about feeling proud today. This is about building a life where money stress goes down over time, a life where you can handle storms, a life where you can wait, because waiting is a superpower in investing and in life. So pick one sign you will improve this month. Just one. Write it down, make it small, make it real. For example, I will build 1 month of essentials in cash.or. I will write my red market rules on 1 page.or. I will stop checking prices in the morning.or. I will only invest in what I can explain in 1 sentence. Small moves done for a long time change everything. That is how people get ahead quietly, not by being fast, by being steady. If you want, share your score in the comments and the one sign you are working on next.